think it's hard to argue with the fact that it's very hard to raise money right now for startups. One of the really interesting features of this is you might argue that in some prior economic environments that were unfavorable, that it was really hard for the really early companies because they don't have a lot of traction, they don't really have product market fit, they're still working things out, whereas the really mature companies who are able to continue to raise money because they have access to larger pools of capital, more diverse pools of capital, they're closer to exit, et cetera. I think this has been flipped upside down in this particular instance, insofar as to say that, right now, like a lot of the growth stage companies were bid up so high in the prior 3 years that they are unable to access capital at like super aspirational valuations at the high end of their multiple brackets, looking at word 12, and instead are being held to, last 12-month revenue projections at the bottom end of their bracket. And that means there's a lot of, flat fundraising, or in fact down rounds, and, soft and hard recaps, and those things are going to happen. And the reason why that's happening is because, unlike the little tiny businesses that have very low burn rates, these folks are burning $1, $2, $5, $10 million a month potentially. And so there is no emergency reserve that can cover you for a long time. And your existing investors, if they're going to step up, are going to drive a hard bargain. So that's definitely happening. The other thing we've noted, by the way, is, again, we're a specialist in the seed and the Series A area, is people are like, oh, it's weird that those valuations haven't really come down all that much. And now I would agree that we are seeing similar numbers, maybe a little bit further down. But the thing that people aren't reporting is a lot of those deals just aren't happening. So it's not like it's like, hey, we're at the same number of deals, but the deal valuations have gone down. We're at a lot fewer deals, and those valuations are more or less the same because those are the deals that are quality enough to attract capital. Now, a couple of other things. If you're looking out in the next 6 months, who knows what the next SVB is? And there's no doubt that despite the actual lack of damage that SVB did wreak in dollars because of the federal intervention, I should say, the fact of the matter is that it was an excuse for VCs to run for the hills. And let's remember, some very large portion of the current asset managers in the VC space have never known a rates environment higher than 3% or a bad quarter in the S&P, other than maybe the COVID lockdown quarter. And so those managers are going to run for the hills to some extent, and I think they're doing just that. But folks have raised captive capital in VC, and so they're going to need to wake up and start spending it at some point. And it'll be interesting to see what catalyzes that. And at that time, whether that be 2 quarters from now, 4 quarters from now, whatever it is, there's going to be a return of liquidity in this market, and startups are going to raise again. So, what does it mean for startups? Well, really control the burn rate, continue to be really quality, try and show folks what you're doing to get to profitability, or at least have profitable type numbers that, show an EBITDA positive economic future for you. Rely on your existing investors and look to them for support. Understand the fact that the terms are not going to be as favorable now as they were, but at all costs, get through the next year. That's the clarion call.